Putting together a strategy to take your required minimum distribution is a little bit like putting together a strategy to purchase a vehicle. Now, you could just head down to the airport motor mile and pick up one of the first vehicles that you see, but your results would not be as good as they could be. In a similar way, if you think about all of the options that you have with taking your required minimum distribution, planning for taxes, planning for where you take those assets, how you take them, when you take them, then you can have better results in the long term. And we're going to talk through those different options that you have today.
So Spencer, for decades, people have been able to save money into qualified plans. So think about 401ks, IRAs, and they've received a benefit from the government for putting those assets in. They're deferring their taxation. They're getting a current benefit. At some point in time, the government wants to come and receive the tax that they have been giving you a benefit for. So really, you shouldn't be surprised that you have a required minimum distribution on those retirement assets. Though none of us like to pay taxes, the reality is we've been getting a benefit, and now it's time for us to pay the IRS the benefit that we've been getting. So what are required minimum distributions? They are simply a government mandate that once you attain a certain age, you have to start taking money out of those qualified plans. So for anyone born between 1951 and 1959, your required minimum distributions begin in the year that you turn 73, as it currently stands after the Secure Act 2.0. Anyone born after 1960 has to begin RMDs the year that you turn 75. So there's going to be this period where some people have to take it at 73 and then it shifts over to 75. And while you might turn 73 this year in 2024, you don't actually have to take your first RMD until April 1st of the following calendar year. Now, if you don't do it, then there's going to be some penalties. But let's take an example where this actually plays itself out. Let's say you're working, you turn 73 in July, and you think, oh no, I've got to take my required minimum distribution. Let's say you have an IRA that has an RMD of $60,000, and you are currently making $175,000 in salary because you're still working, you love your job. So you turn 73 this year, but you're planning to retire in October. Well, this year may make sense to defer that and take that first payment in January of next year, because there's just this reality that you've got a lot of income. And if you don't have a whole lot of income next year, then you don't want to be incurring as much. So that's kind of the reality behind RMDs, is you've got to take the money out. There's some timing on the first one, but subsequent RMDs, you got to take it out every year before the end of the calendar year. So there's a special first year clause, but that doesn't always count. What are some other key things about RMDs that folks need to know?
Well, we want to make sure also, if we defer that first one, then we know that we've got to do 2 in that year. And so in that example that you gave, if we do 2 in that year, that first year of full retirement, then we've got to grapple with the tax ramifications there as well, because the government isn't saying, well, you can defer to that next year and just only take 1. They're saying you have to take 2 in that year. I think the thing that a lot of folks ask is, well, how much am I going to have to take? We have clients even now that we've worked with for many, many years that say, well, it's December, how much am I going to have to take next year? Well, there's 2 factors for a required minimum distribution, and one is the year-end value. So we don't know the year-end value until the year ends. So we're not actually going to know how much a person has to take until we get that value going into the next year. And then the required minimum distribution, it starts at a little bit less than 4% for that first year, and then it's going to inch upward over time. And so, by the time a client is, getting into their 80s, they're having to take an amount that's closer to 5%. As they get into their 90s, they're having to take an amount that's more like 8%, getting into those ranges. If they make it all the way out to 115, they've got to take out about half the account every year. So the percentage steps up a little bit each year, and of course, the account value is the other factor that drives what a required minimum distribution is.
Right. And those percentages are based on life expectation tables that the IRS actuarially comes up with. So there's an actual number that isn't associated with a percent. Maybe it's 27.4. You divide the year-end value by 27.4, and that's where you get to. But like you were saying, it starts about 4%. But it's all based on really fancy math that the IRS has got really smart people working on.
And to be fair, they've updated that here recently. So a couple of years ago, they updated the tables going forward because they realized that people were living longer. They wanted to make an adjustment so that people could take out a little bit less than maybe they were required to prior. Because the IRS looks at this and says, well, we want to make sure that you don't become indigent. We don't want you to be on government help or subsidies if possible. So we don't want to make you take out too much, but at the same time, we still want to be paid the taxes that we've pushed off and given you credits for deferred for over time.
Yeah. Okay, so let's talk about the accounts that are subject to required minimum distributions. So this would be all employer-sponsored plans. So if you still have money in your 401k, 403b. Now, there is a little caveat here that you have to still be working if you are still working at the company and making contributions, then you don't have to take the RMD out. But once you retire, once you stop making contributions, then that is subject to an RMD. You've also got profit sharing plans, traditional SEP and simple IRAs. They are all subject to required minimum distributions. What else do we need to know about those accounts that are subject to it?
Well, one little caveat, if you are an owner of a company and you have a 401k, you still have to take it out actually, because if you own at least 5% of that company, the government is going to require that you take a distribution. If you're just an employee and you don't own a significant stake in a company, then like you said, you could be 77 as a worker and not have to take that required minimum distribution out. One of the strategies as a kind of sidebar here is if you have IRA resources, you're working with a company and you're in your mid to late 70s, oftentimes it makes sense to roll those resources into the 401k, because if you have a traditional IRA and you're 77 and you're still employed, you're going to have to take that required minimum distribution from the IRA, but not from the 401k.
Right. Okay, so this kind of brings in another piece of how you can think about taking those distributions. So one of the things that you have to do is every account that you have that's subject to RMDs, you have to calculate that amount and then take that amount out. Now, if you have, let's say, like you were talking about, a 401k and an IRA, the 401k is going to calculate its value, the IRA is going to calculate its value, but you can't take the entire value out of the 401k.
Right.
So let's run an example. If you've got a $30,000 RMD from your 401k and a $30,000 RMD from your IRA, you can't just take all $60,000 out of the IRA or all $60,000 out of the 401k. You have to take it out each individually. Now, if you've got multiple IRAs, multiple of the same account type, so let's say you've got one traditional IRA at one custodian and one traditional IRA at another custodian, they both have $30,000. You could take all $60,000 from one traditional IRA because they're the same account type. Now, that doesn't, again, you can't do 401k, 403b. Those have to each come out individually.
Right.
Anything else you know there that we could mess up on?
Well, one of the things that we think about strategically is for some clients, they have assets in a guaranteed lifetime income stream. And so we want to make sure that if we have an IRA that's maybe situated in that fashion, that's going to give us that guaranteed income, and maybe that income is above and beyond what the required minimum distribution is for those other set of assets, then we want to make sure that we're accounting for that, and that if a client doesn't want to take out more from that second account, that he or she can have a reduced level that they take out because they're satisfying it across accounts that are of the same type as you mentioned.
Right. You know, Spencer, I think one of the things that we come to recognize, especially over the last couple of years, as RMDs have changed, moved up from 70.5 to 72, from 72 to 73, and then from 73 to 75 in a couple of years, these rules can change. The life expectancy tables can change. So it's really important to work with somebody that can follow the rules, or you stay adept and aware of what are the rules and the landscape of your RMD. So we would say, really, if you're watching this video, reach out to an advisor. It's really helpful to know and to have somebody on your side that's looking out for this landscape. So let's shift over and think about the tax implications on RMDs and then the penalties as well. So like all IRA distributions, your required minimum distribution, it's subject to taxes at ordinary income. And so you want to have taxes withheld on those distributions. What are some other things that we need to think about in terms of the taxation of IRA distributions?
Well, the nice thing there is if we have taxes withheld, then the IRS, regardless of when the tax is withheld, actually the IRS looks at it as spread out over the course of the entire year. This is a nice feature in that if you take it out very late, otherwise you might, the IRS might expect you to, have paid tax in an even way over the course of the year. They're actually going to count it that way in terms of the tax withholding. So it is nice for the tax obligations to be able to match that with a withholding amount actually within the IRA. The other thing that we want to recognize is that you can take distributions that can satisfy a required minimum distribution via what's called a qualified charitable distribution in a way that is not including that income in your taxable income. So we've done videos on qualified charitable distributions and we'll put a link to those. But in essence, we're taking resources and pushing them directly from an IRA to a charity rather than going from IRA distribution into your bank and then you stroking a check to a charitable institution. So that's an important distinction there because that qualified charitable distribution can have nice tax benefits for folks in two ways. One is reducing the taxable income overall, but secondarily reducing a modified adjusted gross income, which would be what the IRS and Social Security looks at for Medicare surcharges. So a couple things there. Qualified charitable distributions can be a great strategy to use in looking at an overall required minimum distribution approach.
Right. Well, and the nice thing about QCDs as well is you can start them at 70 and a half. So if you have income that you know in the couple years is going to push you up into another tax bracket, and you're kind of projecting out and you're saying, oh, when I have to start taking these RMDs, if my account continues to grow, then I'm going to really be hit hard in a tax bracket that I don't want to encroach into. Well, if you take from 70 and a half to 73 and you give aggressively out of your IRA, you can give up to $100,000. And now starting, I believe in 2024, those are going to be indexed for inflation. So you can even give a higher amount year over year from your IRA as a QCD to really start knocking down that future value of your IRA assets. Now, obviously, we don't want to jeopardize a financial plan by giving more than is capable, but if that's a possibility for you, if you want to give in a charitable way, if you want to make sure those resources are passed along tax-free to charity, this is a great opportunity.
Absolutely.
So let's talk about penalties. So we started the video off talking about you can defer that first one, but if you forget and you don't take that distribution for your first year until April 2nd, after the year after you turn 73, the government's going to say, hey, we need a little bit extra. So you're going to be taxed at your ordinary income rate, but then layered on top of that, there's going to be a 25% penalty. Under Secure 2.0, that recently changed. It was 50%, but that's now been knocked down to 25%. So if you go to April 2nd that first year, or you go to January 1st, subsequent years thereafter, an additional 25% penalty tax is going to be added onto your IRA distribution. The other reality here is those can be waived down to 10% or waived entirely. But if there is a shortfall, if you haven't done it, you need to fill out a form with the IRS, Form 5329, submit a letter of explanation as to why the distribution wasn't made, and you need to establish that the shortfall in the distribution was due to a reasonable error and that steps are being taken to remedy the shortfall. So we wouldn't recommend putting off IRA required minimum distributions till the end of the year. But just know that you can be penalized, and those penalties can be really severe.
And they used to be 50%. That was one of the worst penalties that was out there outside of fraud, which is just remarkable. Now, it's nice that they've reduced that, but to your point, you want to avoid this. Now, if you're in a situation where you just find that you've forgotten about required minimum distributions for one account that was maybe a smaller account that you've not been tracking or something like that, then just take the steps to rectify the situation as quickly as possible. We have worked with a number of different clients who have been able to do that and not be penalized by the IRS, but there is no guarantee that they will allow that with all situations. But what we found is that a good prompt letter that explains everything does go a long way in some situations towards being able to help get around those penalties.
Yeah. All right, so Spencer, we talked about qualified charitable distributions a few minutes ago. So what are some things that clients need to do in order to make those qualified charitable distributions? How can they make those happen?
Well, first, three things that I want you to know about qualified charitable distributions. One, you can't take a qualified charitable distribution to a donor advised fund. It'd be really nice if you could do so, but no, the qualified charitable distribution has to go to an individual charity. The second thing is that a lot of institutions, Fidelity and Vanguard and Schwab among them, will allow you to set up check writing privileges for your IRA account. What this allows you to do, if you're good at keeping records and writing checks and these kinds of things, is to write a check to your favorite charities after you've attained the age of 70 and a half and keep record of that. If you've set up check writing privileges, it can kind of feel very similar to the way that you've maybe given in the past if you're writing checks to church or other charities, that you give to. Which can be great. The other thing that you need to recognize, though, as you make those checks, as you write them, is you need to keep the receipts. So it's the same kind of process that the IRS requires, that just as you would itemize deductions, keep those receipts over time, you need to do the same thing with qualified charitable distributions, because it's going to knock down your taxable income there. You're not going to be including that amount, ideally, in your 1040 part of your return there if you're filling that out correctly. So those are a few things with the qualified charitable distributions that we need to bear in mind. There is a little bit of a process there to move through, but it can save us twofold, both the federal tax and then also those fun IRMA surcharges, the Medicare surcharges that would be out there.
Yeah. And the other thing with QCDs we really want to be aware of is the timing. Sometimes charities are inundated with receiving gifts at the end of the year. So really we encourage clients, hey, if you're going to write checks to those charities, make sure that you get them to them by the end of November, and then make sure that they're cashed before the end of the year. It's really important to make sure not only you've mailed it off, but it's mailed it off and it's been cashed.
Right.
So next, we want to talk about inherited IRAs. So this can be really complicated because you've got spousal inherited IRAs, you've got non-spousal inherited IRAs, and the rules are different between them. So what next steps do we need to think about as we inherit an IRA and the required minimum distributions therein?
Well, an inherited IRA, typically a spouse who inherits an IRA from a deceased spouse, 9 times out of 10, we find they're going to roll those assets into their own IRA, and they're just going to take those distributions over time as required by law. There are certain circumstances where that can be different. If we have one spouse with a significant age difference, where the younger spouse passed away first. But generally speaking, we're with a spousal situation, inheriting, it's going to be just required minimum distributions for those assets based on the surviving spouse's age. If it is a non-spousal situation, then we go a couple of different directions. So nothing like a little complexity for a financial planning video. The first set of ways that things could go is if it's going to a non-spousal beneficiary who doesn't qualify for any special benefits here. So a non-spousal beneficiary, that would be maybe a son or daughter that doesn't have any disabilities, doesn't have a reason to need to take those resources out for a much longer period of time. They have 10 years basically to take out a full distribution, and they need to be taking out the required minimum distribution along the way. So mom passes away, son inherits those resources, he's age 50, he's going to need to take out a little bit every year going forward, and then at the end of 10 years he's got to take a full distribution, again, provided that she's passed away here 2023, 2022, 2021. I believe it was 2020 that the laws changed there, but that is the requirement. You've got that 10-year window. Now, if we do have a beneficiary who is disabled or qualifies in a variety of different ways for a longer time frame of distribution, then it could be that they could take just required minimum distributions far beyond that first 10 years, but going into looking at their life expectancy by those IRS tables. So lots of different complexity there. For most folks, if you inherit a beneficiary IRA, then you've got 10 years to take it out, and you've got to take out a little bit every year along the way.
All right, so Spencer, last thing, where do I take a distribution from? When I think about my allocation of stocks and bonds, do I just take it from whatever I want to?
It's a great question, and it really comes back to the plan that we've put together as we work with clients. We want to make sure that we avoid a few things. First, if we are in the midst of a significant market drop, we want to be careful about where we take those distributions from. So for instance, we think back to the end of March 2020, when the stock market had dropped by a third in about a month's time. Well, we didn't want to just sell from stocks indiscriminately there at the end of March. What we wanted to look back is say, okay, can I look at this and maybe there's some other assets that have held up much more strongly than the US stock market. And indeed, US Treasury bonds did reasonably well in that time. They were able to, by and large, hold their value. So we want to look at where we're taking distributions, and oftentimes it just means that we rebalance a portfolio if the stock market has not fallen off a cliff nor gone through the roof. In some circumstances, though, we've had, say at the end of 2021, we had the stock market had gone up really substantially. Stocks were really fairly expensive. So oftentimes what we would like to do in a circumstance like that is sell more from stocks and rebalance the portfolio back to kind of those policy targets that we put in place. So we always want to be thoughtful about where we're taking the distributions from, and oftentimes we're taking distributions from the asset classes that have done reasonably well over the last period, rather than try to just let them continue on their course and run.
Yep. Well, Spencer, thanks for coming back to the goals. I think that's really important, especially as we think about what is that strategy? What are we doing with our required minimum distributions? Coming back to our goals over and over and over again is really helpful. So clients, if you've got questions about your RMD strategy, we'd love to talk with you about it at the next meeting. Otherwise, hopefully you got something out of this. And if you have questions, make sure you talk with a financial professional about your specific situation. And with that, we'll see you next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.